Welcome back. The next corporate on our radar is Credit Access Grameen. Now, the company has an aspiration to become the preferred financial partner for 10 million low-income households lacking access to credit by 2025. The company is also piloting various new innovative products like payment products, savings and investment products via partnerships, insurance, etc., designed on meeting the evolving needs of its core target customer base. Uday Kumar Hebar, the Managing Director and the CEO at Credit Access Grameen, is now with us on the show. Sir, morning. Rima here. Can you talk about these pilot projects of yours, particularly insurance? What is the game plan? What is it that you're trying to achieve, your aspiration?
Good morning. Pleasure to be here. Yeah, as you know, in India, insurance penetration is quite low and more low than the rural. Therefore, our promoter, Credit Access India, and we headquartered in Amsterdam, have a plan to have a process in the process of commencing life insurance business in India, focusing low-income households, micro insurance, but in life insurance segment. So the business is separately a separate subsidiary of the promoter, which will be housed separately, and it's called Credit Access Life Insurance Limited. So they are aiming to do this, complete the entire license and approval process the next 6 months' time, 1 to 2 quarters' time.
This will be separate from Credit Access Grameen. This is going to be a project of the promoters.
Absolutely.
So the distribution channels, etc., what about the synergies that you can get?
Absolutely, because Credit Access Grameen itself is being treated as FII by having more than 75% foreign shareholding. We cannot be the domestic partner for the insurance company. So it's a promoter invested insurance company, and Grameen will be captive subsidiary, captive business partner for this business along with other insurance companies, and we will definitely innovate more and more. Low-income household specific products actually, which will be more suitable for the low-income households, for our customer segment. It will be helpful for us to get a synergy in terms of developing the right products in this segment, and then whether it is for insurance or a savings or investment, we can actually develop that.
Right.
And the synergy will be very good in terms of the captive business and captive support.
Okay. Now this is, as you said, not part of the listed entity. This is separate run.
Absolutely.
Synergy is one thing, Mr. Hebar. What about diversion? There's limited bandwidth, right, to run one business.
There won't be diversion because it will be a separate company, separate management, separate premises, separate process, separate technology, everything.
But same promoters.
Different company.
But same promoters, right? Same promoters, right? That's why I'm asking. Is
promoter, of course. But promoters' involvement in both the companies. Both companies will run independently. Of course, promoters will give you strategic directions, being board members, like the Grameen, they have been giving the strategic support, and then continuous support of anchor investor both sides. So that will be the major role of promoters, so, not into management, because management is definitely driven independently by two different companies. Therefore, we don't see any diversion either in insurance company or in Grameen because of this initiative. Nor promoter, because promoter is independently sitting in Amsterdam, and they will continue to support and guide strategically for both companies.
Is this why the news of the promoter selling stake in the company up to 5%, germinated?
Not really, because the promoter has sufficient capital, and they already set aside the required capital for this purpose. Therefore, there is no need of additional funding requirement at the promoter holding for this purpose. In fact, they're able to raise capital if needed. For example, just on 5th, they disclosed that they raised 2% from one of the Italian bank. It's called Banca Sanpaolo, already invested in this company, because they have sufficient ability to raise capital if needed. But as of now, there is no need, because they already sufficiently set aside this capital requirement for this company.
So Mr. Hebar, you are confirming that the promoters don't intend to sell any stake in Credit Access Grameen, and all the reports of them selling up to 5% stake, etc., are all bunkum?
No. I am clarifying that they don't need to sell stake for the insurance company purpose. Whereas promoter company has been invested by more than 250 shareholders, patiently investing as and when there's a requirement of money for Grameen over the last 15 years. So therefore, promoters want to give some liquidity to them. But in the meantime, promoters also realizing the fact that we need to improve the liquidity and floating stock in Grameen also, because it's a tightly held and very high promoter stake. So to match these two, promoters might sell about 5% per annum for at least in the mid-term total, not more than 10 to 12%, to give a liquidity to the old shareholders who have been invested and patiently with us, with promoter for more than 15 years. But this is very minute, which probably works complementary to support the liquidity and floating in Grameen stock book, as well as to support the patient investors who have been there for last 15 years.
No, Mr. Hebar, 10 to 12% is, you're saying, the maximum they will sell, and 5% every year. But you said to old investors. So this will be, this won't be in the open market. This will be normally, this will be on the block deal kind of thing. The idea is to increase the free float, the number of shares available in the market, right?
Absolutely.
Because you need to stay at 25%, at least 25% as well, yes.
It is always ideal to have a good free float and good floating stock for any company. So which we need to do at a point of time. So therefore, promoters are thinking on that. But it will be mostly on a block deal kind of thing at a reasonable, and the price reflecting the company's valuation with the right market, correct? Right market fundamentals.
Mr. Hebar, we don't understand that, because if it's done by a block deal, it is likely to go to an institution, and again,
multiple institutions. It's
so
not that one
why would you not
multiple...
why would you not then dilute the stake via a QIP? In that form, the money comes to the company as well, and the free float increases while the promoter's absolute holding remains the same.
QIP, when you do QIP, it will not reduce the overall float. Even right now, we don't need funds. We are already sitting with 30% capital adequacy, right? 20. So we might take another 3, 4, 5 quarters for us to add more capital. Not necessarily now. It is actually but till that period, we cannot increase the float in any case. If we wait for that kind of time, therefore our intention is to promoter intention to reduce not more than 5% in any financial year, but not more than 10 to 12% overall in the medium term. But yeah, it will take step by step, not immediately.
Mr. Hebar, we're out of time, but thank you very much for talking about the promoters' insurance plans and the possibility that they will sell up to 12% stake in the next 2 to 3 years. Their current holding is about 73.5%, the promoter holding in Credit Access Grameen, and I guess that could come down at most to about 60%. That's the stock currently down 1.5%. But as a part of our series 2023, my colleague Prashant also caught up with S. Narain, CIO at ICICI Pru AMC, to understand how we expect the markets to behave in 2023 and if he sees domestic inflows continuing into our markets. Listen in.
SIP flows are extremely strong, and what's different, if you ask me, at the start of 2023 is, if you go back the last 2 years, interest rates were very low.
Right.
So people said, why should I invest in debt?
Right.
But if you go back and think where we are today, interest rates are much higher.
Right.
So what you get in an overnight fund is almost 6% and higher.
Correct.
So interest rates are much higher. So people are thinking, should I allocate to debt?
Right.
And should I allocate to equity? Or should I allocate to both?
Right.
And this is a question anywhere in the world people are asking, because they're used to 13 years of zero rates everywhere in the world.
Correct.
So I think the picture is more mixed on flows.
Right.
It's not that the flows are bad.
Correct.
Flows are still good.
Correct.
The SIP flows are outstanding.
But some of that equity flow is also going into debt instruments, etc.
Yeah, I think the non-SIP flows are likely to go partially to debt, because debt has become an outstanding asset class.
Is that what is happening in the last 2 months, the mutual fund data that we get, right? The SIP number is at all-time high, but the discretionary, non-SIP number actually is is not looking good,
It's
right?
logical. It's logical that people will also consider debt, because if you're going to get much better returns on debt than you were getting 2 years back or 1 year back, why wouldn't people consider debt?
But it is going into financial products. I mean, it's not as if that money is not coming into.
Yes, yes.
It's getting invested, not
Yes,
in equity, but in.
Yes,
in
clearly. If you look at the last month, what we saw was that debt index fund
Right.
have received huge inflows, and that's something which possibly as a product didn't exist 2 years back. So I think clearly we are seeing a situation that people will consider debt and SIP,
Right.
both,
Right.
and that will be the change which we will see in 2023.
Okay, I always, you've always been actually one of the very few true value investors. You're very contrarian as well, and to be contrarian while managing such a large amount of money, to take those calls and make them public, I mean, I think it takes a lot of courage and conviction. So what's the big call for 2023? Is there a big call, Naren? Or as you said, it's more mixed and muddled as we start the year?
No, I think the big call will be that inflation will become much smaller as an issue in
Okay.
2023.
Okay.
And therefore, we are in a situation where multi-assets become very interesting.
Okay.
That you consider all the asset classes. You
Okay.
consider a product like multi-asset, which can invest in debt, equity, gold,
Right.
silver, REIT, InvIT.
Right.
You can do everything.
Right.
Because I think that kind of an asset will become much, much more interesting, because you're still going to have a volatile year ahead.
Right.
Because growth in every part of the world is going to slow down.
Right.
You're not going to see a situation where maybe inflation will become less of a problem. Doesn't mean interest rates fall.
Right.
Interest rates will stop going up.
Right.
They'll stabilize.
Right.
Whether they're going to crash, I don't think so.
Large caps versus the rest of the caps, mid caps, small caps. You like large caps because they offer valuation comfort, I believe, right?
See, basically what has happened this year is the bulk of the selling. See, you know, once you have selling, market corrects, then valuations become cheap. Let's look at where there was selling this year.
Right.
It happened by FIS.
Right.
Where did the FIS sell? They sold in large caps.
Right.
So large caps became the area where bulk of the selling has happened this year. So large caps became the area where valuation comfort is there to a higher extent.
Okay.
Mid cap and small cap, the mutual fund industry ensured that there was continuous SIPs.
Right.
So that area there's seen virtually no selling.
Right.
So those areas, the valuations are not
You
cheap.
were also in the past famous for calling out a segment which is looking frothy. Is it looking frothy, mid caps and small
They're
caps?
looking clearly costlier than large caps.
Okay.
Because see, you need some wave of selling
Okay.
for the valuations to correct.
Okay.
And there has been no wave of selling for years now.
Right.
So, and retail was also positive.
Right.
So that's not an area where we have seen any selling.
Right.
Once you see selling, the sector's valuations correct.
Right.
So that's why we prefer large caps over mid caps and small caps. We also like flexi caps.
Right.
Because what happens in flexi caps is at some point of time when you want to invest in mid and small,
Right.
because mid and small are structural areas.
Correct.
So at that point of time, you can actually buy mid and small cap also.
Right. Right.
So that's how we look at it.
And one area in the large cap space which has corrected a lot, we spoke about it earlier as well, is IT services, right?
Yeah.
One big sector which is down significantly still. You still like that?
See, our view is very simple. Both the export-oriented sectors, whether it is IT and pharma, both have done very badly in the last 1 year. If you look thematically, those are the two sectors which have done very badly. We think that both these sectors are worth systematically investing over the next 1 year, because there is possibility of global recession. So you invest into the recession, you normally make money. Just like, you know, people who invested in banking into all the banking problems
made
they
a lot of
made
money.
lot of money.
Yeah.
Something similar.
So buy a IT fund or
Yeah, you can buy even an exports fund which covers both,
Right.
or you can buy a separate IT fund, technology fund, separate healthcare fund.
the other area which has seen a frenzied move is this entire PSU bank space. So I want to start there and then come to private banks. Any interest, any idea whether this could continue, in your opinion?
See, it's a very tough call. You know, we were some of the people who actually, in many of the funds which I run, we made a lot of money out of PSUs. Most of the time when we invested, people asked us, will you ever make money in PSU stocks?
Yeah.
After they have run up, when people ask me this question, I don't know how to answer them, because tactically they look very good.
Right.
But you should ask, in 2020, the number of questions we were asked.
Why are you buying?
Why do you have PSU as your top holding?
Right.
Even today, where I have a PSU as my top holding in some of my stock funds that I run, top holding. And most of the time, including some of the younger people in my company, they ask me, how can you have a PSU as a top holding in your stock?
Right.
And they've all done so well.
Right.
And I have to answer my younger colleagues in my company, I have to answer distributors, I have to answer investors. And when they do well, people ask me, will they continue to do well?
You mentioned briefly metals, right? When you were last on, you said
Yeah.
don't buy producers, but buy consumers.
Yeah.
Is that still the way you look at it, or is it reverse now?
See, metals have corrected a lot. And if there's a good, big China reopening, it becomes a tactical trade after the correction.
But that could be now, right?
It could be now. So structurally, I think tactically, it's an interesting sector to look at.
Okay. Steel, non-steel, the entire...
Both
Right.
actually. And unlike 6 to 9 months back, there's no frenzy in the sector. No one talks about it.
Correct.
So that's how we look at it.
Naren, any other themes that you want to look at, any kind of idea, consumer users versus producers, anything like that, which you'd like or avoid?
No, to summarize, what I would like to say is that people should believe that mutual funds also are a vehicle to invest in debt. They should continue to practice asset allocation. Anyone who practiced asset allocation benefited in 2023 and 22. They will continue to benefit in 2023 by doing either multi-asset or asset allocation. And do logical investing. Don't get carried away in euphoria. And I believe that it is not yet time to actually press the accelerator and take big risks. That time will come. And when that time comes, and if we get it right, we didn't get it right in June, but if we get it right, we will tell you. In March 2020 and April 2020, we were very clear and we did communicate. But in June 2022, we were not that clear. But we still believe we are in that middle of the road path. And that's what we think we are in. But Indian macro has been beautifully handled.
Yeah.
India is a fantastic structural story. But against that, we have record valuations.
Great market, but great valuations as well. That's S. Naren, CIO of ICICI Pru AMC, saying in the last line, not time to press the accelerator and take big risks. And that time will come sometime maybe in 2023, but a more middle of the road kind of view coming in from S. Naren of ICICI Pru as we look into the next year. We'll take a quick break here. Up next, Mitesh will be with us for some technical trading ideas. The market, by the way, is seeing the second dip. The first one got completely bought. The Nifty came back into the green. We're down about 50 points now, 18,371 on the index.
Well, the low and the high of the Nifty today have been 18,300, 18,2995 at the lower level. At the higher level, we've seen the Nifty just barely, touch that 18,450 mark. So that's the broad range that the street is working with. And that has given a lot of these option writers a lot of gusto as well. 18,400, both call as well as put, have seen an equal amount of open interest addition. That's telling you that a lot of people are writing straddles, basically a call and a put together. 41 lakh shares added on the 18,400 call for a premium of 100 odd rupees. Pull up the 18,400 put, you have a premium of around 110 odd rupees out there as well. 41.6, eerily similar number of shares written out there as the call as well. So what this basically means is that now that the street has a range that it wants to work with over the next couple of days, the range is 200 points from 18,400 on either side. So 18,200 at the lower level and 18,600 at the upper level. Today, however, the range has been around that 150 odd points. What does one do now that we've seen an opening dip which has been bought into, that rally that has been sold into, and now we're in the middle of the range? Mitesh Thakkar joins in. Mitesh, what do you make of the first hour so far? Any interesting trends?
See, I think 18,300 came into play and we got a very strong bounce back from there, but it's been sold into. The overall setup isn't very positive, but I think that pivot at 18,300 is a very important one. So we'll not go aggressively short on the index till we start trading below that. But I think, on the stock side, we've started exploring some short positions. I think that's the key takeaway. Let the index break down that level and then, be aggressively on the short side. But till then, keep adding on to your short position where stocks are giving breakdowns. And one of them is ABB. That's a sell with a stop at 2,900 for targets from 2,800. And the other one is on the long side. The sugar stocks and fertilizer pack is doing very well, and Balrampur Chini is something which is broken out on the upside. That's a buy with a stop at 386 for targets of 410.
Mitesh, thank you very much for that. Let's shift our attention now to the commodity markets. Manisha, what's the one commodity that you're tracking today?
I'm looking at copper, but just because Mitesh mentioned sugar, let me tell you that there has been a big run-up in sugar overnight, and we are trading at near 5-year lows in the international markets for raw sugar prices. I think that is where a lot of momentum is coming in from. But back to copper, and that has been quite volatile as well. Overnight, it was a 1.5% of a decline. For the week, we are 2.5% down, and for the year, we are trading in the negative with 11.5% of a cut coming in for the copper prices. Well, the reason that you have seen decline is the slower China growth. All the data has come in on the weaker side for the month of November. The US dollar is back on the strong foot, and the aggressive rate hikes that the street has seen in this week, whether it's from US, ECB or Bank of England, all of that seems to be weighing on in case of asset classes. Take a look at what the copper prices have done in the US markets in this year. We saw a record high above $5 per pound. The low has been 3.13 and the current prices stand at 3.8 as of now. Looking forward in case of inventories, and that is where maximum support comes in from, the LME inventories are just about 2 days of global consumption. When you look at the worldwide copper inventories, that stand at 4.9 days of global consumption. So there is a lot of support expected from these numbers there. The outlook for 2023 clearly depends on the global inventories, which have continued to be on the weaker side. Also, when you look at the copper cathode global inventories, those are also at a 14-year lows. Markets also are looking at the EV production, green transition investments. That is expected to surge, and that would mean a lot of copper demand going forward from here. There also is a report suggesting from Anglo America, which has cut production outlook for 2023. That could really add to the premium in case of the copper prices. Glencore as well says that IEA net zero emission estimate does put the copper deficit to around 50 metric ton for 2020-2030 in that next 1 decade there. This is a report from Wood Mackenzie, which also says that there are underinvestments that you have seen in case of copper mines from a peak of $32 billion that was invested. 2025 perhaps could see just about $12 billion there. Outlook 2023, well, this is the most important one to watch out for. Goldman Sachs, for one, is expecting all-time high prices in copper in the next year at $11,000 per ton. Take a look also at Bank of America. They're also expecting higher prices, but an average of 9,750 is what they're looking at. You also have reports from Fitch, Bank of America, PNB. Bank of America is another one. $12,000 per ton is what they're also anticipating into the markets there. Fitch is looking at $8,000. So from where we are trading right now, most of these banks and brokerages actually are looking at higher prices in 2023. BNP Paribas, ING also trading or looking at prices above $8,000 per ton there. There also is a Citi report which expects the copper prices to range between 7,000 to 8,500. Cochilco, Chile, of course, is an important country. They're expecting 3.7, so higher from where we are trading right now for this one as well. And then there's a report from BMO, which also says that they're expecting copper prices up by 9% from the current year prices. So quite bullish copper forecast for 2023 is what is being expected.
You know, Manisha, thank you very much. Commodities in focus. By the way, the market is seeing the second leg of the fall, which has taken it down 70 points, 18,344. And this is what we were saying in the morning, that, you know, the impulse is to buy and bears won't stand in the way after the recency bias is so strong that dips just get bought, right? And who wants to stand in the way of a powerful up move? And we got a powerful up move from the day's low. Market came back into the green, but the advice has been to stay a little cautious. And we're down 72 now, so this is the second leg of on the index. GMM Fodler is seeing a big cut. As we discussed this earlier, let's revisit this one. Abhishek is here with more. Abhishek.
Well, Prashant, Fodler intends to sell about 29.88% equity in the company. So in amount-wise, this translates to 1.34 crore shares. And in offer size, this translates to about 2,283 crore and about $277 million. So Axis Capital is the sole broker over here. The floor price is at 1,700 per share, which is a steep discount of 11.67% to yesterday's closing price. Now, the promoter holding will decline to 26.18% versus 56.06% earlier. Take a look at the historical trend in terms of stake that Fodler had in GMM Fodler. So, if you see in June 2020, it was at 50.44%, and as of 30th September 2022, it was around 31.9%. So, post this block, they'll have a residual stake of just a little under 2%. Back to you.
Thanks very much, Abhishek, for that. So that's GMM Fodler, and we'll get you some perspective. Maybe speak with the management at some point in the day, get an analyst perspective as well. But thanks for that. We'll take a break here, and we come back with our special segment. It's the economy. My colleague Lata will get chatting with Sumit Kariwala of Morgan Stanley to discuss outlook for banks from here out. Stay tuned for that.